In this upcoming video, we're going to dive headfirst into multifamily properties. If you're interested in building a portfolio outside of just single-family properties, pay attention to this upcoming video. Let's go! Hey everybody, Russell Westcott here. I'm looking forward to bringing you this brand new video upcoming. So if you're looking to take the leap from single family to multifamily, there's an old saying in the world of multifamily properties, you don't attempt multifamily, you go into multifamily. You need to become an expert. The community of multifamily investors is small and tight, and you can't afford to make a mistake. So to help you make that transition from single family to multifamily, I found an expert, one of Canada's leading multifamily investing experts, Mr. Pierre-Paul Turgeon. You're going to thoroughly love this episode. We go into many deep dive topics, transitioning from single family to multifamily, the capital required to get into multifamily, buying your first property, risk assessing, how do you present to investors to get involved in your deal, and so much more. As a quick note, this video is 4 parts, all stitched together for one continuous video for you to watch. And just make a note that this was recorded a couple years ago, back when the opportunity when we could actually go see each other in person. And I sat down with Pierre-Paul on his ranch just outside of Calgary, Alberta in Cochrane, and we had a wonderful conversation. It's interesting to note and see how the market has changed over the past couple years. The Alberta marketplace is now open for business. I am now just releasing this video to the public because it's been in the private vault for members of my personal community. So you will thoroughly enjoy this conversation. And if you're interested in making that transition from single family to multifamily, bookmark this video, share it with others because you'll be coming back to it often. All right, let's get after it. All right, welcome back, everybody. A beautiful sunny day out here in Cochrane, Alberta. My good friend Pierre-Paul Turgeon just made this amazing breakfast. It's early in the morning. We're gonna have a beautiful cross breeze flowing through here. Life is good.
And I made 2 eggs with fresh eggs.
Fresh eggs from my chickens. From the chicken coop. So life is grand, my friend. So guys, we're gonna get right to this. Pierre-Paul Turgeon, welcome.
Thank you, Russell.
How long has it been, my friend?
Since we know each other, since we've been involved in real estate.
Well, how about how long has it been since we've known each other, and how long has it been since we last chatted, really?
So we've known each other, I guess it's 10 years this year, this being 2018. And since we've seen each other, it's got to be 2-3 years. 2-3
years. So it's fun. I'm having a blast doing all these interviews, just reconnecting with some really good people.
Yeah, very cool.
And you know, I'm from Saskatchewan, and as my mom says, use good people. Right? So guys, we're gonna have a wonderful conversation here. We're full of tomatoes and avocado and bacon and fresh eggs and cappuccino. You make a wicked cappuccino here in Pierre-Paul's beautiful home here. So how I've been starting off a lot of these interviews is, I'm sure that a lot of the people watching this know a lot of your story. They know, the CMHC role, and you're the multifamily expert, but not everybody does know that. Okay. So maybe if you can just spend a few moments and give us the, and we're showing our age by this reference of Cole's Notes, the Cole's Notes version of and just for some context about where you've been, and you have this could be an entire episode of just where you've been. You have an amazing story.
I have
on
your
education.
Story. An amazing life.
Yes, absolutely. So maybe just for the context of within realm of real estate and all that fun stuff, share that with us.
So my key background as it pertains to real estate is obviously my background at CMHC. But what people may not know is CMHC used to have, I think they still do, have some international activities. And I was a project manager at CMHC's head office in Ottawa. So that was providing, consulting advice to foreign countries how to set up what we have in Canada, which is mortgage default insurance. So I was a project manager. So we worked in places like Africa, Gabon, Mali. I worked in the Middle East and Palestine. We created PMHC, Palestine Mortgage and Housing Corporation, which to this day still, originates loans and all of that. So, and then I just wanted to acquire a hands-on. I was a project manager, but I wasn't delivering the housing finance expertise per se. So I took a job in the Calgary office at CMHC to acquire the mortgage default insurance. So I became an underwriter. Right. I became an underwriter for single homes first, people buying principal residences or small rental properties, 1 to 4 units, like a duplex up to a quadruplex, if you will. And then after that, I did a stint, quite a long stint, 4 years in default management and real estate at CMHC. I actually managed that department, and that department has it's twofold, two sides to it. The real estate side is the real estate when people default on their mortgages for small, either small rental properties, 1 to 4 units, or principal residences. I had a small department that was working with the lenders to mitigate the claims. And if the lenders were unsuccessful after foreclosing on the properties, if they were unsuccessful in selling these properties, my small department would take back these properties and expose them to the market again. So I was managing those staff. In addition to that, the default management, and this is relevant for why we're sitting here, you and I, that was my key area, is manage defaults of apartment buildings.
Yes.
And as you know, I'm a coach in this area. It's kind of cool because not only do I teach the front end of the business, how to acquire apartment buildings and invest in them, but also I know what a bad multifamily deal or apartment deal looks like. So it's kind of teaching on the offensive as well as the defensive. So that's been my story at CMHC.
So that background, it just perfectly ties together. So you've been in real estate for a lot longer than you've been in real estate. Yeah. You've had some amazing training, of seeing it from the other side.
Yeah, absolutely.
Right. And you could see how much a wingnut sometimes real estate investors are, because you can actually see it from the bank's perspective.
Absolutely can. Right. That is the perspective I offer and what they want to know, which is relevant for today's topic as well. Because what the banks want to know is also what our investors want to know.
Yes.
Right. It's what are the risk factors and how to mitigate them. And that happens to be my core expertise. Indeed.
And as much as we like to think we live in a society of just go for it and just live on the edge and just, crush it out there and all that kind of stuff. We live in a world of really risk mitigation. And that's human nature is more, they do more to protect themselves from the risk than actually going for their dreams.
No, absolutely.
So,
it's investing. There's always a risk involved, but we can do a good job to minimize the risk and the potential of having issues with our risk investment. So it's a good training. I can't deny that it served me well.
Good training, but there is a fine line between being so cautious that you actually don't do anything. Yeah. And then also to actually have enough information and mitigate enough risk to actually move forward, which the next phase of your conversation, of your story is, when did you take the jump into being an investor? Yeah. A direct investor.
Yeah. I got to backtrack a little bit. Yeah. My spouse has always been involved in real estate. So I'm very lucky to have a spouse.
You married in the up club,
but she never made the move into apartment buildings, obviously, because it's a different game altogether. So I'm lucky to have a spouse that can have these conversations. She understands the side of the business. But for us, because I want to speak as a couple, because it is a couple business, we're both in it for the good and the bad.
Yes.
We made the move. I wasn't happy, as you said, my former colleagues at CMHC, despite having all the same knowledge I have, working at CMHC, you're right, they wouldn't be taking the kind of risks you and I take to invest in real estate. And I was tired of that cubicle, what I call cubicle mentality at CMHC. You got a song sheet, you got to sing it, you got a script, you got to abide by the script and all of that restraint. Always. And, having an employer owning my time and my freedom of thought. So that's something that I wanted out of. And I was increasingly unhappy with CMHC. But let the truth be told, I saw how much money people were making with real estate and apartment buildings in particular. And the story I like to tell, to that effect, Russell, the big aha moment came to me in 2008, 2009. So let's backtrack a little bit. What was happening in 2008, we live in Alberta. So I compare everything to the price of oil. Sorry, guys, but everybody in Canada should know more about oil because it's 30% of our growth.
It actually is a driver of Canada's economy.
30%.
So as rightfully or wrongfully, it is what it is.
Just a little hint, you guys. I lived out east. I didn't know any of these things.
Yeah, but this isn't an Alberta accent, right?
No, French-Canadian. That's a sexy French-Canadian accent. But anyway, so the price of oil in summer of 2008 was $140 a barrel. But then all hell broke loose, as we recall. The international financial system broke down. Banks were lending to each other. Anyways, it was mayhem, total mayhem. And little me, decided to put an offer in August of 2008. My deal closed in December 2008. I'll remember December 5th, 2008. Some of those dates you never forget, right, Russell? Because then the rest is history.
Your first kiss, your marriage, your birth of your children, the day you put an offer in that the market tanked.
Yeah, within weeks. Right? Because 2009, if you recall, marked the beginning of the Great Recession, the greatest recession since the 1930s depression. And here I go. So that was my first move. I still wear the scars proudly of that because you learn from these things, right? But what I saw, I was still an underwriter at CMHC, so a multifamily underwriter. At that time, we forgot to make that link from my workplace. So I managed the default and real estate department at CMHC. And then I went on to move to the multifamily underwriting department. So I became a multifamily underwriter at that time. And so in 2009, I had been an underwriter, multifamily or apartment building underwriter, meaning that my job was to assess the risk as it pertained to CMHC insuring these apartment building loans and mitigate them, maybe reduce the loan amount and all sort of stuff like that. But so in 2009, at the peak of the Great Recession of 2009, what happened amazed me. That's my big aha moment. I saw so many people make money with apartment buildings at a time when this is the greatest recession since the 30s. And that's what that's really what woke me up at that point. Also, I had bought my first one at that timing, but it was reassuring to know that if you make it through, you can make big bucks because people were refinancing their apartment buildings, pulling some large landlords millions of dollars, at least hundreds and hundreds of thousands of dollars out of those properties. Because what happened is the interest rates went down significantly.
To nothing, essentially.
Yeah, like 1.5%, I think overnight, they dropped by about 1.5%. So that's sort of when I started the big move. And since then, now I own 160 doors, a portfolio worth about $23 million.
Wow.
Yeah, it's been a ride.
And obviously you had all the money in your bank account in cash sitting there to buy all those properties. So you had to learn the art and the science of raising capital.
Yes.
Right? And what is your ballpark number that you would estimate in capital that you've raised for?
I know that. It's $6 million.
Six? Okay.
Yeah.
I'm keeping track because right now I'm affectionately calling this the $100 million interview series because it's now over $100 million in capital raised.
Okay.
And I'm going to be interviewing a guy that soon is going to even have almost double it. So I'm going to have to maybe call it the billion dollar club. So suffice it to say, you know what you're talking about.
Yes. I mean, it's been trial and error to a large extent, right? In our years in our previous careers, what you did a lot of great teaching that I remember about raising funds, but picked up on models like that, adapted it to my circumstances.
Yes.
Because I don't know who your audience is. I would assume there's all sort of investors, real estate investors, people that invest in small rental properties as well as large ones.
There's three types of people that are audience. People just getting started, which is usually the majority of people. People that have bought some properties and accomplished, and now they're ready to start buying some bigger things. And then there's also going to be a group of professionals that are ready to scale and ready to 10x this into the $50 million raise, $100 million and more. And so there's a wide range. This conversation is, I would consider, the accomplished to scaling a little bit more advanced.
Yeah, but all of it is mindset. As you know, Russell, I teach this stuff as well. People say, hey, I invest in small rental properties. Can I do the multifamily thing? Absolutely. You can do anything. And it's not just BS. Like, it's not just rah stuff. It's all your mindset. You have to work on your mindset. But one thing I need to tell about me when I raised money, so it's been a trial and error. Some of the tools initially I used weren't quite appropriate. Had to tweak them for my world. But my world is the big leagues. Of real estate investing. That means what? That means that the world of people or the number of stakeholders is a lot smaller than for smaller rental properties. I mean by that, the number of realtors you're going to work with, mortgage brokers, lenders, and so on. It's a much more finite world. So you need to walk a straight line and know what you're doing. You need to do a lot more homework than you would. And it's the same thing goes with raising money. You need to cross your T's and dot your I's very, very specifically. It's a lot of work because the stakes are higher and your reputation, you need to build it up. And after that, it precedes you. Like, I never look for properties. Properties come to me because Pierre-Paul has his stuff together. And people who work with me know that, but you have to prove yourself up front. So I just want a little caveat here.
Absolutely. So you're really looking for the select few in both capital and opportunity.
Correct.
Not looking for the broad many.
Yeah, and I would, now it's a tough time for us, as we've said, in Alberta and real estate wise and all that. And in these difficult times, the choice of investors, of partners, joint venture partners, call them shareholders, call them what you will. I am so happy that I took the time to select them carefully. With one exception, we stick together. It's a marriage. It's a marriage relationship. Raising money and investing in real estate, especially apartment buildings. That's another distinction now that I know I have a better sense for your audience. Apartment buildings are definitely a long-term investment. Real estate always is if you want to be successful, but for apartment buildings, even more so the case, because it takes longer to stabilize the property, right? To maximize the performance of the property. So that means that when you raise money from somebody, select them well, make sure that they understand that your investment horizon or the investment horizon that you're contemplating is long-term, not short-term. You can't sell a multifamily property very quickly if you're needed cash or stuff like that. And in the tough times, you know that they're going to be there. They're not going to be whining and complaining. So it's important.
Typically in the world of multifamily, you're actually looking. You are out there looking for the biggest problem. The biggest problem because typically the bigger the problem, the cheaper the price, the better the price, the better the opportunity. Which is a little bit a different mindset sometimes than single family. Sometimes the single family people are they're looking for brand new and they're looking for easy and they don't want to do all the work. Right. But so you're looking for those problems because it's going to take. You got to have the intestinal fortitude to actually turn around properly. It could be a couple years before it actually gets turned around. Oh yeah, and sometimes more than that. It might be the first loan term of typical loan term is 5 years. So it takes a while. It depends. And this is the challenge about teaching this. You and I do. Every property has a personality of its own. One might be an easy home run where you can turn it around within a year, if the repairs, the upgrades required are not too significant, depending what you're buying. Some of them, you don't want to kick out all the tenants, evict all the tenants. You still need to cash flow. And oftentimes, Russell, and this is something also that I teach, I like to put enough money in to secure the investment, to assess the risk factors as physical property risk factor that I call, what conditions the property in, if we need a new roof and all of that. But also I like to, on tenant turnover, take the cash flow of the property, re-inject it to continue the stabilization of the property. That way it doesn't reduce your cash on cash return type of thing. So, but everybody's different. Everybody and every property is different. You may be able to stabilize it faster depending on its condition at purchase. Wow, you said a lot there. And I know there's so much that we can unpack, and that's why you've put together an entire program, 50 plus videos and growing each week. I hope we can add this video to that program as well. Of course. Can you just give maybe and we'll just talk broad strokes to start for diligence on a building. What is the most important things that you look for when you kind of go through? And I know when you do your live workshops, you actually bring people, take them to the roof, you get down into the boilers. It's a very hands-on, experiential. Absolutely. Super important to me. And so for somebody watching this, and maybe they're thinking about multifamily, what is your Pierre-Paul's, what is your kind of criteria you look for down the list? And it's tied to raising capital, right? Russell. The better due diligence you do, the better the story you can tell to the investor. Yeah, it's a double whammy because if you do your due diligence properly, which is what I teach, which is the core expertise that I have as a former multi-apartment building underwriter, and it's the same kind of system that I use to convince investors to invest with me. So there's basically 4 key risk factors in any real estate deal, including small rental properties. It's your property risk. What condition is it in? Then it's your market risk, right? What kind of market are you investing in and all that? What are the going cap rates in your given market and all that? Then the valuation risk. Are you paying too much for the property or just the right amount? Or, is there a deal there that you're buying under market value? And if so, why? You need to investigate why. Because sometimes buying under market value doesn't mean it's always a good thing. There might be something hidden there why it's below market value. And then the 4th key risk factor is you as an investor, as a borrower. So property risk factor, market valuation, and the borrower or investor risk factor. And your job, it's the bank's job, but us first, before we get to the bank, is to assess these risk factors and mitigate them accordingly. Right. But if you're going to approach somebody to raise money to buy one of those apartment buildings or a smaller rental property, you need to convince these people that you're aware, you've assessed these risk factors thoroughly and mitigated them as best as can be as to minimize the chances of these risks, flaring up and increasing your chances of having a successful investment. So if you guys are paying attention, I hope if you haven't got a pen and paper, I think you better get one right now. What Pierre-Paul just gave you was an absolute... It's a framework. Golden presentation framework. Well, and just to correct me if I'm wrong,
Yeah.
property, market, price, valuation,
Yeah.
and then you, the investor,
Correct.
as well.
And it's important
brilliant
to see ourselves as a risk factor because we are. Like that's, and you're right. You said at the beginning of this interview, Russell, this is, it's just a cool place for me to have this knowledge. And when I raise money, that's how I pitch it to my investors. I literally go through these 4 risk factors and I tell them, you have to be succinct, right? The problem, especially with novice people, and I think we've all been there, at least for me, I'm sure you have in your early days, we tend to write too many words, get to the bottom line. And that's an easy framework to remember. 4 key risk factors, and you go through them. And when you conduct your due diligence, you analyze them, you assess them. And I pitch deals like that to investors.
Nice.
That's exactly the way I do
And
it.
we're going to, in the next segment, we're going to talk here shortly about your MOSES plan. You call it the MOSES plan.
Yeah.
So before we get that, I do have a question, but we will have to part the Red Seas in order to have the MOSES plan. We'll have to come down with the tablets with things. So a fear. There's a lot of people have fear of talking to others about money.
Yeah.
And you know, where it comes from is irrelevant. It's a real fear. Did you ever experience those fears maybe when you first got started? Maybe even today you may have that fear. And how, obviously, in order to raise $5-6 million for capital, you've had to get past it.
Yep.
So do you experience it, and how does somebody get past it?
I really, really appreciate that question because I'm a speaker and coach and trainer in these. Absolutely. I come from a humble family. I'm number 9 of a family of 12 in some mining town in northwestern Quebec. And there was no money around. We were somewhat poor. And so that's something that if you want to raise money successfully, you got to get over it, guys. You got to get over that money thing. And you got to come from a place of abundance, especially, Russell. And of course, that's a mindset that I had to adapt and adopt. And the good news about it, quite frankly, now in the age of YouTube, internet, there's so many resources out there. So I have daily rituals, many, many daily rituals. One of which, I got it here. Sorry, I'm going to be out of range for a second here. But, for example, this is a little something, but this is my gratitude rock, for example, Russell. So when I get dressed in the morning, I never go, see how pretty it is? It comes from the shores of Lake Titicaca in Peru. I was there trekking to Machu Picchu and biking in Bolivia with him a few years ago. Because of real estate investments, by the way, otherwise we wouldn't have that freedom. Can you hear the Lake Titicaca? But so a sense of gratitude, right, helps for happiness. But what I like about today's world and having our iPhones and technology, there's so many great tools to motivate yourself. So first of all, you have to come from a good place, and we have a choice of our thoughts. I don't want to get too woo-woo on you, but I do work on my
bang a drum and sing Kumbaya here.
But I do work on my mindset, Russell. This is something that when it comes to raising money, you have to emanate that confidence. But again, what gives it to you is doing your homework, going back to the risk factors and assessing and conducting your due diligence very thoroughly. That's how you build up that confidence to approach somebody, because you've done your homework, you've crossed all your T's and dotted all your I's. So if somebody doesn't have it at the beginning, that's one way of adopting a system that will give you that confidence and build it. And I make a point of teaching that. That's what I tell people. At the beginning I was afraid of raising money. Even now, having difficult conversations with my real estate partners now, but it's not personal. If I've done the best with the investment, managing it, which I know I do because I'm up there. There's nothing I don't know about this business, very little, because I keep asking others, by the way. It's not just all my own knowledge. To this day, I seek to improve my knowledge, calling other landlords and calling lenders and, brainstorming. But if I know I've done all my homework when I approach a potential joint venture partner, I feel very secure, very confident. And that's the way to do it. It requires a lot of preparation. Yeah.
So if I just again, you say a lot, and we both can speak really fast too.
Yeah, so guys, no,
I'm teasing. I'm teasing because with a good tailwind, we'll get up to about 140 here, and we'll feel like you're surrounded. But so really, it starts with yourself.
Yeah.
Really, and first of all, it starts with yourself. But if you think about it, fear is actually an internal thought process. If you're actually only thinking about yourself, you may feel fear. But if you actually think about serving others and providing, and that's what you said with the next part. The next part was being so confident and you know what you're doing and you've mitigated all the risk.
you should be going out and just standing on a park bench and being happy to tell people because you're now providing a service to others.
Yes. No, it's important to be serving others, and it's a long-term responsibility. So absolutely, Russell.
Yeah.
But you have to you have to work on your mindset. You have to get rid of your limiting beliefs pertaining to money and all of that. But you have to do your homework. It's a combination of everything. But the good news is mindset is changeable, and we choose our thoughts. People think our thoughts are imposed to us. No way. Do you know how many thoughts a day the average human being has? That's a pretty staggering number. Do you have any idea?
No, I don't actually.
It's about between, and I'm talking some of them maybe just a few seconds, not even fractions of a second in terms of thoughts, between 60 and 80,000 thoughts a day. How much garbage you think goes between the left and the right ear every day? And we have a choice. We don't have to let that. So again, when it comes to money, you got to choose the right thoughts. You got to hang out with people, good people that don't have hang-ups about money, but it's all a conscious choice. Every thought is a conscious choice. Same thing with your relationship with money.
Nice.
Again, mentality of abundance versus scarcity.
And if that's too woo-woo for everybody, what you said at the very beginning is just get over it.
Get over it.
Right? If you want to be successful in this game of real estate and you don't have all the capital required to buy, you're going to have to figure it out.
Yeah.
Right? And you're going to have to get over it. You're going to have to get out there. You're going to have to start making the opportunities available for people. You got to put a good plan in place, which is what we're going to talk about.
Okay.
So I'm going to just reset the cameras here. So everybody, I'm here with a good friend, Pierre-Paul Turgeon, and we're just getting warmed up. We're just about to...
Should I fix another
we might have to get a couple more cappuccinos going here. All right. And we might go until the sun goes down, right?
All right, sure.
So I'm going to just reset the cameras and we'll be right back. All right, so we're back. So as you can tell, we weren't we're a little low in the energy.
Yeah,
there's no passion here, so whatever. So cheers. Cheers. We got a new fresh cup of cappuccino. So I might have to zoom in. Look at that. That is like a Pierre-Paul.
That's a little full. I didn't do a little. Mine's got a heart.
Yeah, that's like a work of art here. Look at that. That's like well done, my friend. That's like hang on.
Nothing like a good coffee.
Very good coffee. It's one of those pleasures of life is a nice cup of coffee.
Listen, I mean, if we could show people, right? I live on an acreage. Yeah. Today's a blue sky day. Yeah. Usually I sit to the east, watch the sunrise with my little cappuccino, often with my wife. You know, I'm an early bird, but little pleasures of life, like my fresh eggs that we had this morning from my chickens.
And if you look out this way, other than with the trees in the way, you got the Rocky Mountains in the background here too.
Yeah, life is good. I mean, it's not always easy, and this real estate business is not always easy. But at the end of the day, you know, I work from home. It's some of those pleasures of life and more freedom. You know, it comes at a price, but definitely worth it. I don't miss my cubicle at CMHC. You know that, Russell.
And we were just saying before we turned the cameras on how blessed we both are of just having, just wonderful family. Yeah. And that's why we do a lot of these things. That's why we're up early in the morning and we're working our tails off at times so we could actually have time with the family.
And take on the risks.
Yes.
But the rewards are commensurate, usually.
Yes.
Not always, but usually.
Well, these hard times are creating strong people.
You know what? And these are hard times. And let's pause one moment. I do feel that. And again, we were talking about mindset. This is challenging. If you're a real estate investor like we are in Alberta, these are very challenging times. It's a different Alberta. But at the end of the day, there's a side of me that feels really good because I'm growing, I'm learning, I'm getting better at what I do. And believe me, I'm learning lessons, right?
Some of the biggest mistakes I've made were during the really good times. And didn't put the money aside, didn't, refinance to unrealistic valuations and pulled capital. Some of the biggest mistakes I made were during the really, really good times. Right? So
you got to
prepare for the bad times and the good times and capitalize during the bad times. Which I think people should do right now. Right?
Absolutely.
So Pierre-Paul, you had mentioned something earlier about the Moses Plan. Now we've parted the Red Seas, and we're sorry for getting biblical here in it for a moment, but I think it's a wonderful acronym about how you present. It's how you present your joint ventures, or another framework of how your deals are structured.
Yeah, it's another framework. It might be a preliminary document that you give. But again, I want to remind novice investors, and being French, I talk a lot and I have used words, lots of words.
And if we tied your hands together, you wouldn't be able to say anything?
Well, io parlo l'italiano, lo posso fare anche. I speak Italian also, that's what they'd say. Tie an Italian's hand, he'll stop.
He's got half the words.
Exactly. And it's true. I know this for a fact. So it would be a preliminary document There's different stages, but the idea, and I'm just trying to share my what I've learned, right? Obviously, for people's benefit watching, being succinct is important.
Yes.
So the Moses Plan, I got a copy of it here. I had to refresh my memory a little bit what I've got in here, but it's a preliminary document, and it's an acronym that stands for a management plan. So it stands for management, and then the O is the opportunity, and then the the next letter is S is structure, and then E is the exit, how you're going to exit the investment if somebody wants to exit, and the last S is security, right? Okay. I can go through it very quickly.
Well, let's unpack it a little bit here. Yeah. I think it's an important framework, and so we'll unpack it and we'll go through it and we'll get some notes.
I want to give some idea, but I mean, it's a great tool. It's a preliminary document that if, to present an investment opportunity to investors that gives them a good summary of what it looks like. Yeah. And then I go into more details if they say yes, if they raise their hand and say, yeah, I'd like to continue investigating this investment opportunity. Yeah.
So I think more important than just in and of itself of the Moses Plan is that you actually have a plan. Most people don't have a plan, whether it's called Prime or Platinum or whatever it's called, whatever acronym works out to, that you have a structure.
It's very structured.
And when people read that, they get the confidence that, okay, Pierre-Paul knows what to do. At least he's got a plan, but some people don't. Yeah. Right. So walk us through. So M was
so M is the management. So who's going to manage the property? Yes. Who's going to do the accounting? Who's going to do all of that? So that's who the investors, they want to know that. What are your credentials as a manager? Because if you're the so-called finder or the opportunity finder, if you will, what credentials do you have to do this and how are you going to do this? So it's all that kind of stuff. So that's in management. Who's going to do the bookkeeping? Who's going to do the accounting? What kind of reporting are you going to give your investors? All that. So that's in the M, under the M. And then the opportunity. Right? Why are you investing in that specific marketplace?
Yes.
What is the opportunity with the property itself? Why is it a good property for you and your investors to invest in? Right? And so you go on and describe that, and if you can fix the numbers, improve its valuation, and do a refinance or whatever the opportunity is pertaining to the property, you want to describe that. Then the S is structure. What kind of legal structure to own the asset? Is it going to be a company? Is it going to be unanimous? Are you going to use a unanimous shareholder agreement, USA? What are you going to do? And then, do you have an acquisition fee or something like that? So giving the kind of details about the deal. The exit, well, I mean, people's circumstances may change. So somebody may want to exit the deal. So how can they do that? So you would explain at a high level, how this can happen. That's kind of what the idea of the E. And then the security is, you have to provide personal guarantees, which I need to tell people, you need to provide personal guarantees on these loans. Yes. It depends. This is, obviously not the purpose of this talk, but depending on the type of financing, sometimes you can do away. If you go conventional financing, i.e. non-CMHC insured financing. For example, in my case, if I go conventional financing, I have the strength and the personal net worth. I don't have to bring all my shareholders on board to provide personal guarantees. If I go CMHC, pretty much start with the premise that everybody who's a shareholder who has a so-called beneficial ownership in the asset will have to provide a personal guarantee. CMHC is trying to be a little bit more flexible these days, but don't count on it. Right. Unless you go below 60% loan to value, so, put more money down. You don't have to provide personal guarantees because there's enough security in the asset. No, the loan is low enough. But that's what goes into the security, the final S in Moses Plan, the acronym.
Wow, that in and of itself is a presentation.
Well, just a tip, right? I mean,
I think that's brilliant. Now, a couple things. We're gonna unpack that a little bit further. But in part of the training, I trained people.
I feel like it's Christmas. You're unpacking a lot of stuff.
Well, it is Christmas. I'm sitting with Pierre-Paul Turgeon, and he's just dropping all this knowledge here. And that's one of the actual commitments I have for this program is I'm actually doing it to learn myself. Yeah. And the more conversation, I've been doing it. Almost 18 years. Yeah. I've raised a lot of money. Yeah. And every day I learn. And the commitment I make is to everything I learn, I want to share. Yeah. And that's what the program is all about, is just sharing with others of theirs. So one of the things I do teach people is, if you've ever had that conversation about, and I'm just going to use a rough example of 50-50. Yeah. And somebody goes, well, what are you doing for your 50-50? Yeah. What are you doing for your 50% share? And then I teach people, why don't you just document all that you do and build your value proposition? That Moses Plan but you share to people. You just built your value proposition. Right?
Yeah.
Because of all the things that you do. You know what you're doing. You have a plan. You actually have a framework. You have a structure around all those kind of things. Super
critical.
Right?
And I've learned a lot from you in those years. I remember you about joint venturing. I learned here on my lawnmower tractor, riding around the acreage and listening to those CDs of you. So I'm indebted to you in that regard, Russell. I did learn a lot in that regard from raising capital. I need to tell you this. And he's not paying me to say this, okay? It's a fact. Remember those CDs?
Yeah.
I still had one of those CD players on mowing my lawn here on my acreage. I was listening to this over and over until I became a fundraiser, until I became comfortable with the concept. Absolutely. Yeah. That's how but it's one thought at a time again, right? You choose to become or be what you want to be.
Well, thank you. Thank you for those kind words.
That wasn't planned, by the way, but now that you're refreshing my memory, I actually see your presentations or your content. So I've learned a lot from you.
Okay. But yes, so thank you. But I'll tell you what, you've just taken it to the next level. And I think that's a true testament to a coaching, no different than you doing a lot of coaching yourself, is you want your students to actually achieve everything that you've ever done. Ever done that. And quite frankly, they're standing on shoulders of giants, which those are some pretty big shoulders over here, especially in the realm of multifamily. You're a pioneer in this. You've taken a lot of the education that's out there and you've consolidated it and you've made it so people actually take action and they're not scared of doing it anymore.
That's why my teaching is experiential, hands-on. It's real deals, and it's important to learn hands-on. And you got to take action. I mean, it's just being a seminar junkie is no good.
Yeah. So back up a step. We're going to talk more about your Moses Plan here in a second, but in the logical progression of a conversation, your investors, you're looking for a select few high net worth individuals, people that understand bigger deals and they can get into stuff. Where do you typically find them? Do you go to networking events? Is it through associations or referrals? Like, where do you typically find those people?
So again, we mentioned that in the first part of this interview that it's important to choose your, investors, your joint venture partners very carefully. In my case, I'm lucky to evolve in an environment with high net worth individuals, medical world or dental world. But in today's world, you need to be out there. Now there's internet, doesn't take much to be on YouTube and stuff like that. I've had, as you know, some exposure as a speaker through different associations and all of that throughout the years. That helps somewhat give me a bit of exposure, but I'm just privileged that I hang out with people from the medical world or engineers, people with high net worth, and this is maybe a bit of a challenge when it comes to apartment buildings. I mean, you can do a setup. I still have a very simple setup. I don't do limited partnership or, I don't raise money publicly just because it's my style that's my approach. There's, I try to keep everything simple because life is complicated enough. So, I could raise money publicly, but then you're subject to the Securities Commission and all that. I, to this day, have chosen not to. This may change now because I have a certain degree of maturity. Now I've been doing this for 10 years. So from a gradual point of view or graduating to that level, I think now I'm more comfortable doing that. But I wasn't there before. And certainly for the novice people watching this interview, I would recommend keeping it simple. But when you raise money for large apartment buildings, you're talking millions of dollars, right? Depending on the market you're investing in, certainly it's easy to buy $2-3 million, $4 or $5 million property. So you want to have people with high net worth and who have the money, who are not dependent on that money, because we've said at the beginning, it's long-term. It's a long-term investment. I mean, mistakes. Let's talk about that a little bit here. For example, my brother-in-law, their first building I bought on my own. My first apartment building, I actually bought the store I told you in 2008. That was my first one on my own. But I had been a silent investor with another partner, somebody that we both know well, who's also very successful in the world of multifamily investing. But I was just a silent investor. So that's also a good way sometimes.
So you learn by being the other side.
Although the only challenge with that is sometimes they don't share that much information with you.
You learn what not to do in some cases.
Exactly. So from that perspective, I had a little bit of experience with that. But, you go gradually. And I bought it on my first, and I approached my brother-in-law. I came up with $50,000, and he had to refinance his home to do this. Okay. That $50,000, and there's actually more than one brother-in-law, to be honest with you, come to think of it. which also did the same thing. These people refinanced their money to give me $50,000 to buy this property that we're now, first time I ever sell a property. But that particular brother-in-law at some point had some financial challenges. His young son passed away in a motorcycle accident and all that. And all of a sudden, that person needed that $50,000. Right. So you want to be cognizant of things like that, what it means. So, what I do now, I don't get, first of all, I don't take small amounts like that because of all the systems I have in place, my credentials, my experience at CMHC and all of that, my track record. I don't take, the smallest amount of capital I'll take is $150,000, and I don't have too many of these. Right. They're usually even larger amounts. The reason being is that it becomes unmanageable the more stakeholders and shareholders that you have. So you have to be mindful of managing that as well. So it's managing the expectations. And I think this is also from you that I've learned this. I do have an investor questionnaire.
Yes.
But the idea here is to make sure to be in sync with the expectations that your investors have, their investment horizon. And like I said, even their personality, because in tough times like I am in now, I'm very grateful to have taken the time to select investors that are with me in the good times as well as the bad times, right? Because it will come. Real estate is cyclical.
So really, you've taken the time, and you mentioned you've essentially evolved into this, and you've had to prove your chops,
absolutely,
prove your each step of the way, and now you can be welcomed into this high net worth community because you've done a dozen years of work up before, and then how many more years before that with what you did with CMHC?
Exactly.
So you've earned the right to get into that.
You earned that right. It's definitely earned.
And you can be kicked out pretty quickly.
You can be kicked out pretty quickly when things go sour.
Right. So, so really somebody here, so if to get a message across to people watching is, guys, this is the long term. This is the long game. You're in it for the long game. And don't be upset if you're not in the doctor, dentist, high net worth circle right now. Mm-hmm. Just wait, because they're watching you. Yeah. The high net worth people are watching what you're doing. They're seeing what you're doing. They're letting you make the investment into yourself, into your mindset, into maybe cutting your teeth on some other different type of properties before you can make the transition to the next level.
Yeah. Right. And what people, you just mentioned something that's important. People invest in you first, not in the assets second.
Yes.
And so how you, behave yourself and how you prepare yourself is everything. Yeah. It's everything. Preparation.
Yeah. In one of the other interviews I had, the fellow was saying, some people came to them after 6-7 years after first contact. And they finally said, I think you figured it out finally. And you've made all the mistakes already. So I'm ready now. Here's my, by the way, are you okay to start with $500,000?
Yeah.
Right. So
I get these large amounts now. Yeah. I mean, it's not every day, but I do have. And here's the thing. I mean
it's not raining cash.
No, but I do want to say something, Russell, and it's not to pat myself on the back, but those systems. So I just gave you, this stuff, again, that's why you do this series of courses. This is like the Moses Plan or, using the framework that I talked about. You're right. There are priceless because a lot of us didn't have all these tools, right, when we started. But the idea is that's what you attract capital. You don't really raise capital. Yes. And it's by having these systems in place that you can accomplish, that kind of a result.
Do you feel it's, and now this is a little bit of an age-old pardon the pun, because we just had wonderful, the chicken and the egg question, some wonderful eggs this morning. Do you feel that you need to have a good deal first? Or do you need to go out and make lots of presentations and things like that? It's a little bit of a chicken and an egg, but
what do you think? I love that question, though. Yeah. So for me, clearly, I'm a hands-on kind of guy. Yeah. Hence the reason why my course, my training is experiential. I usually need to have a deal first to do the best of job. However, the same process, like the Moses Plan, I have approached people at a high level saying, I don't have the O stands for opportunity, which is the building and the market. But so I would describe the market in detail because I had that information, that data. And then I would say the kind of deal I was looking for. Mm-hmm. So to answer your question, generically speaking, for example, you don't want to over leverage financing, which is something, given what we know in Alberta, for example, I never exceeded, I've never been one of those that would go to the highest loan to value, for example. That's one way of mitigating that risk factor. The valuation risk factor, 75%. I never exceeded 75% loan to value. So I would describe that. I would describe what the property would look like as best. So certain parameters that are generic. That's how I would do it. But of course, you do a better job of convincing an investor when you have a deal in front of you. The challenge is that's part of why you have no hair left, Russell, because it's very stressful. when you raise, you got a deal in front of you, you've got an accepted offer, and I got a receding hairline. So I've had the stress of raising money, once you have an offer in place, accepted offer, but that's, it's easier when you have a deal in front of you because then you can be very specific with specific numbers. There's great tools out there as well to put all that data, the numbers together. What is it? Property Analyzer, and it cranks out graphs, and it's like $50 on your iPad, and then you print it. You can incorporate your logo and all this stuff.
Yeah, it was an Excel-based spreadsheet. I just saw one that just came through.
That's not Excel, it's PDF. But you put all your numbers and draws all the beautiful graphs and your return on investment and your pictures, and it's fantastic. But I mean, the point is you got to do your research. There's tools out there.
I usually ask, when someone asks that question, I usually ask the question is, okay, do you have an opportunity on the go? Yes or no? If it's no, then okay, do you have some leads on that you're working with some money partners? My point I'm trying to get to is, whatever you got, start with what you got. Right? Don't let what you don't have stop you from keep moving forward, because you can always get a deal opportunity. A deal opportunity doesn't mean you're buying it. It could be one you're analyzing. And I had a conversation with a guy the other day, and his first joint venture partner came to him from, he was just analyzing an Excel spreadsheet and a cash flow pro forma, and someone at an event said, no, let me take a look at that. I was looking at, that looks pretty cool. Good. The next day, the guy phones him and said, I'd like to put money into that deal.
Wow.
And he's going, well, actually, I don't own it, but good conversation. So then he qualified him and then filtered, and then he bought another one like that.
Yeah. No, there's stuff out there. And,
whatever you got, start with it.
You got to start. You just got to start. You got to start.
You mentioned something, and I'm actually going to just quickly reset the cameras here because I know this is going to be a deep conversation. So the next segment we're going to get into is of that Moses plan. We're going to talk a little bit more about how you structure it. And I know you keep it simple, but I think there's going to be some gold that we can bring out to people, because sometimes here's what people think when you get into multifamily. They think that it has to be offering memorandums and LPs and this fee and that fee and structure, and they'll be quite surprised at how simple you structure it. It looks very similar to almost like a single family type of thing. But we're going to get into a lot of those kind of things, and we'll unpack that in a bit. So we'll be right back. Oh man, battery after battery. Good thing I got 6 batteries. So Pierre-Paul and I are just diving headfirst into. We're going to talk in this next segment about how you structure some of with your money partners, and you keep it. You subscribe to the KISS. Keep it simple.
Absolutely,
right?
Stupid.
Keep it simple, and keep it simple. Silly. I guess.
Okay, silly.
Not stupid.
Not stupid.
Nobody's
stupid.
Well, definitely no one in this room.
Not us. Not us.
So. In a nutshell, do you use a joint venture agreement? Maybe just describe it in core concept, and then maybe we'll get into some of the fine details.
That's evolving. I think something I didn't mention to people, I do have legal background, so I do have a law degree. So that helps a lot. And no offense.
Helps and hinders?
Yes. No, it really helps with the real estate part and with the structuring of these agreements. To be honest with you, going back to our early days when we met, when we were part of
you had more hair. I was still. Okay.
But when we were part of that real estate association investment network, some of these agreements weren't quite suitable. I have to tell you that much now, right? Looking back, and I still have 2 of those kicking around. And since then, I realized I need to adapt those. But again, my principle at this point, I don't do anything super sophisticated. And you're right. You're right in stressing the fact that it's not necessary, and it's especially when you start. So I usually want to make sure when I invest with people, I know them well. I've talked about that because in the good times as well as in the bad times, it's going to be a lot easier. But also making sure that they understand, as I said, the expectations. I understand their expectation and the investment horizon. So simplicity is key. I don't do, I used to use joint venture agreements. Now I use a unanimous shareholder agreement, which is not significantly different than a JVA, right? A joint venture agreement. It's got the standard clauses and all of that. So that's what I use. Now I get into a bit technical detail because I know all about financing, which is one of my core expertise. The banks, when they look at your financing application, they want to know who's in control of the asset.
Yes.
Who's got signing authority in the event of default,
Who's
which
the
goes
leader
back.
of the marching band.
Exactly.
Yeah.
And who's got the credentials and all of that. So in my case, in the unanimous shareholder agreement, I have, just regular shares. Like I don't even recall, all of a sudden I haven't looked at one in a while, but my wife and I have the voting shares always, 100% of all the voting shares. Might be a bit overconfident, but I do know what I know, and I don't know what I don't know. But what I want to have all the voting shares. The reason being, I'm the subject specialist. I know what I'm doing. I've got connections with the lending world and lenders and the realtors and all of that. My expertise is looking at those operating statements on a monthly basis. That's also the core expertise that I bring from CMHC, right? On a monthly basis, I review these numbers. And it's me that gauges the market, what the market is doing, what's the best strategy at any given moment during the investment period that we have the asset, we hold the asset. So I have all the voting shares. So that's the first thing.
Okay. So in order to have a unanimous shareholders agreement, each one of these apartment buildings has to be its own corporation.
Correct.
Which you typically have to have anyways.
Absolutely. And this is also a risk management structure, right?
Yeah.
So that you don't have a domino effect. So none of the buildings, so we own 7 properties, 160 doors, as I said earlier. None of the other properties are being given as collateral for the other properties. So,
good to know.
So it's a risk management, right? All silos. So sorry, good point. They're all individual corporations in which my wife and I have the voting shares.
Personally or another corporate structure?
So that's up to you. Yeah. Now in later years, I do have a holding corp that owns my wife's and my shares.
Okay.
Yeah, but it's an extra cost. You got to produce financials every year. So you got to keep that in mind. Yeah. I try to reverse it. Those companies that we own our shares in our personal names, super costly.
Yes.
So I started down that path and then I realized to backtrack. Ideally, this is something that, again, is specific to every investor. You want to consult with your lawyer and your accountant. Yes. Everybody's different. So in that regard. But if I knowing what I know now, perhaps I would create that holding corp up front. Okay. I think so, because now I'm big enough, my portfolio is of a good size. That might make more sense, but understand that there's a cost associated to that.
Yeah, so basically weigh the cost versus the benefit. And you're going into the deep end of the pool here, so make sure you get good advice.
Yeah, right? It's important that and good advice that is customized to your needs and your own circumstances, right?
Yeah. Okay, so you have a unanimous shareholders agreement. You and your wife hold the voting shares. Is there a certain percentage of that you hold? And then what's the other shares? And that
so again, this will vary, right? Yes. In my case, I know my stuff, but the 50-50 that people are used to in smaller rental properties, that doesn't work well in my world.
Yes.
Because we're talking millions. So you're asking people to put up a lot of capital.
Yes.
So the kind of stuff, and I'm going to keep it at a generic level, right? Yep. But the kind of stuff that you want to look at, you can always get an acquisition fee. I usually get something like that. Yep. It's a percentage of the purchase price. Okay.
An acquisition fee.
Acquisition
so typically
fee.
Around
1%, something like that,
of
right?
The purchase price.
Of the purchase price. You can also throw in there a asset management fee, right? Yeah. So which is not like I've done my research. These are kind of standard things. Although sometimes in difficult times you can't collect on that asset management fee. Right now, I hate to say. So you got to
collect when it's there.
You got to be prepared for that, right? Especially if you're the finder. In terms of percentages, and this is something you used to teach. I'm sure that's what you're going to be teaching these folks. I've learned from you. It depends what you bring to the table in terms of expertise. In my case, it's quite significant. Yeah. But I don't do 50-50, but it may be easily somewhere between, and it depends how much capital is involved. The more capital, you got to kind of lower that number, but somewhere between 20 and 30%.
Okay.
Is in terms of my share of the equity, or my wife's and I shares of equity.
So let's just, for round numbers, let's just say it's 30. So you would have a 30% ownership. Your investment partner would have a 70%.
Correct.
Do you charge a disposition fee as well? I've heard
you could. Yeah, you could do that. Yeah. Okay. But again, you got to adapt that to it, depending what percentage of acquisition fee. If you're very generous at that end, maybe you want to be less generous, but that's also a possibility. Yes.
Right. Okay.
Yes, I have some deals with a disposition fee, or when you refinance, a refinancing fee. It's a lot of work. Russell, this is a lot of work, guys, okay? I'm looking at all 3 cameras here so that you all understand.
The whole audience.
A guy like me makes it sound sometimes too easy. So first of all, I'm an active investor, as you know.
Yes.
So I have a deal right now that's approved.
You're full time. This is your business.
I'm
This is your
full
profession.
time. Yes,
You're a master.
and
of
I
your
take
craft.
this super seriously.
Yes.
Like I said, reputation in this business is critical. Like if you mess up, unfortunately, I remember the first part of the interview, I said it's a finite world, the world of apartment building investing. And so if you mess up with a lender, unlike small rental properties, you can always find a corner BMO that's going to work with you or another mortgage broker. In my world, if you mess up, it doesn't forgive easily. So you're walking on eggshells. So you got to be careful about that. So I'm super well prepared for that. That's really important to make sure that I'm prepared. But right now I have a deal that I'm refinancing, and I prepare my own financing applications because why? I used to tell the lenders, the banks, this is what you need if you want CMHC to insure your loan. So I know exactly what they want. And my binder, I gave it to the lender. I give this on a flash drive in Word format.
I'm sorry, I'm smiling because we could tell an inside joke about the package.
Oh,
right?
yeah.
We might not get there, but it's for those of you that maybe you're long-term.
I forgot the word financing in there, and so I was talking about my package on stage, right? 700 people laughing their heads off, and I didn't know why.
Pierre-Paul kept bragging about his package.
Well, I still brag about my package to this day, because this financing application I got on the lender's desk right now, I got approved, we got everything, and it's cool because I know what outcome to expect. And this is the stuff I teach as well. It's cool to know and to have that relationship with the lenders. But in any case, they never called me once to say something is missing, right? But so that's the kind of preparation that you want to have. And they will ask you, Russell, who has control of the asset. So that's one of the key things that they want to know, who's got the net worth and all that. But as far as the structure of the deal, that's kind of it, basically. You can have a disposition fee, you can have an acquisition fee, and a certain percentage of the equity, which will depend on what you bring to the table, the expertise and the know-how.
Do you usually just have one investor per property? That's nirvana. I would understand. It's probably just one per deal.
So I got to tell you, the system that I use works so well that the majority of my investors, this is pretty cool. And again, it's not to brag, it's just a fact. It's the same people time and time again that are high net worth individuals that come and invest with me because I use this kind of systems, risk mitigation and assessment systems that I've mentioned. And yes, I do have some of those buildings. One particular guy is my largest investor. I treat him like gold. And champagne once in a while, and but he knows everything is run professionally. So
and then what kind of shares does the investment partner have in the USA?
Non-voting shares.
Non-voting shares. At 70, and
70,
pardon me
80%.
if my ignorance in this is that I do know a good portion of it. How do you set out like 100 shares and then it's based on the number of shares, or how do you do it?
It's, honestly, off the top of my head, I didn't think you'd ask me that question. I should know this, but after that, it's my lawyer does all of that. So let's say there's so many, it's proportional. So let's say
there's 100, 30. You get 30, he gets 70.
Or 100, I get 100, they get 200 type thing. If it's 30-70 type thing, something like that, Russell. It's that simple, and it's allocated. The stuff, that's the lawyer does that. As long as you agree on the key numbers, the 30 or 30-70 or whatever, 20-80, the lawyers will do that. But the key thing I want to stress again is who has voting shares. And in my case, the banks have faith in me, right? I've never defaulted on a mortgage. They know my background at CMHC. So but you need to tell the lenders that who has control of the asset. In case you default, they need to, get you to sign on the documents. They can't go running around. So the idea is about the structure, Russell, is again, keeping it very, very simple. And it is that simple, just what I described to you. And something, you would describe in the agreement, when are you going to distribute cash? Things like about the contingency fund, all of these kind of things would be described in the USA Unanimous Shareholder Agreement.
Awesome. Now I'm going to run this thread of it's an analogy and it's an example. So let's say I've got $250,000. Fall to what you do, and let's say $250,000 is enough to buy into your next deal. We've met. You've known me. It wouldn't be enough, by the way. It wouldn't be enough.
No.
Okay, what do you need? 400.
Oh, more than that, depending where my market.
Are you guys getting? He's already up in the amount of money.
No. But I mean, it is true. Like you need nowadays in my market, right? I'm investing in Edmonton, although I live just outside of Calgary. You need nowadays. You'll need a good $600,000-$700,000 at bare minimum.
I got $750,000.
Yeah.
Look at how he just raised the amount of money that I was willing to contribute. See, there's a good salesman here. Always.
Well, it's in cost today's dollars.
So obviously you've qualified me, and we we have an alignment. We think we can work together.
Yeah.
What do you what's part of your process as the next step? Do you like, is it offering a letter of understanding or a memorandum, or what's the next step before we get into, or do you just go right to the USA, or how do you take
at that point we go right to the USA. Once the investor has, as you said, we've managed the expectations. We know what the investment horizon, when all the minds have aligned, then we just sign the USA. Normally we need, and that's another very important tip, you need to have your investors send the money early.
Yes.
Early.
Okay. So you need the money before you actually go shopping? Or do you kind of...
Ideally, Russell, this is what we talked about, the chicken, which one comes first. Here's the beauty. Again, because I have repeat investors, because they know me, they know the system, they trust me and all of that, sometimes I don't even sign a USA yet. The money will send, because you need money for deposit and all of that. So they will, but I do open a bank account very quickly. I don't do bookkeeping. I don't do accounting. I leave that to specialists. My job, that's not my area of expertise. So I leave that to professionals, but I open a bank account. And if they've signed the USA, they can forward the money straight into that bank account so that the bookkeeper can track all of that money. It's professionally done. So there's no issues there.
Every dollar to go through that one account, because it's an easy bookkeeping process.
Easy bookkeeping. It's just super important. I stress that a lot, Russell. And the other reason why you want to have that money up front is, and this is stuff I cover. I'm not here to sell my course, but this is, I've been doing this so long. We know what questions, what's on people's mind, what they need to know. We've got in Alberta and across Canada now the anti-money laundering issue that we have to deal with. Where's the money coming from? And normally you want to have that money sitting in that corporate account. It is a business account, usually at least 3 months in advance, right? In that bank account. Ideally, this is ideally, that's what you want to do. If not, and I warn your audience here that they need to tell the bank where the money came from, right? They want to ensure that it didn't come from some terrorist source. So if your investors puts in whatever amount of money, they need to be able to backtrack your transfer of funds, how they ended up in your bank account. So just a caveat, it's a lot of work.
Yeah, and quite frankly, that's why your investors are happy to contribute $750,000 is because they don't have the time to do all that work, right? And that's why you get paid what you get paid as part of the process, is because you take on all those details.
And I meant to tell you earlier about the financing application. Like not only did I've got the best financing application in the country. It's so much work. It's a month and a half, 2 months
and
worth
typically,
of work.
In the commercial world, they charge you for that privilege.
1% of the loan amount.
Are you able to save that typically, or do they still charge you that?
No, they charge me a bit of a fee, but I'm saving it. But more above all, Russell, I'm in control.
And you get it done.
I get it done. Like I said, this application I just got approved, we're going to get funding in a week or so. The lender did not call me once, but I just want to say to people, it's work. I don't want to sit here with you and make people believe that it's easy, but you can all do it, and you get the kind of rewards that you and I benefit from.
Well, that's what I actually, you do make it look easy, but I actually, that's one of my definitions of a professional, is somebody who takes something very complex and complicated and makes it look easy. That is the definition.
System, absolutely.
And you have a procedure, and you have a system, and you're relentless and ruthless to making sure that it's done. You have a PhD in pig-headed determination.
Yeah, I'm rigid, and my job, again, I'm going to repeat myself, but these are the key things that you need to know. In the world of multifamily, yes, the rewards are commensurate, because we make more money with less effort. The effort is up front. Once that's done, it's more of an easier ride than small rental properties, right? Less sweat equity involved, less volatility, lower risk asset by a long shot. I don't want to get into that because that's not the point. We're talking about raising money, but it's all part of the rewards that you get when you get into the world of multifamily. But my job is to make everybody else's job easy.
But you have to be prepared.
Well, that means I have to. So let's talk specifically about raising capital. So the lender's going to want to know, like I said, for reasons that I said earlier, but also the realtors. The realtors, they want to know, do you have the money? Because the world of multifamily realtors is a lot smaller. They don't want to waste their time with somebody that hasn't, figured it out and doesn't have the money. It's just kicking the tires. tire kicking in my world of investing in large apartment buildings not accepted.
Yes.
So that's why. So they'll need to know. The first person who's going to know is the realtor. Do you have the money to buy the size of property you want me to look out for you on your behalf? And then it's going to be the lender. So you need to know this in advance. Have that in a bank account. And it reassures the lender. The lender was going to ask you very quickly.
Nice. Well, we are going to do one more segment here. I got a really cool line of questioning on the final segment. But before we wrap it up on here, where can people get a hold of you? Where's the best website? And you talked about your multifamily course.
Yeah.
Where can somebody maybe check out that information if they're into this world?
Well, it's multifamilyinvestingcanada.com.
Multifamilyinvestingcanada.com.
Yeah, the acronym is MIC. Yeah. So multifamilyinvestingcanada.com. Yes, I've been doing these. You were at my very first one. It's evolved so much since then.
6 years ago or how long?
2011.
2011? Yeah. 7, 8 years ago.
Yeah, it's a while. 7 years ago. It's experiential. I teach people literally all the tools, all my multifamily hacks from beginning to end. And it's experiential. As we said earlier, it's about hands-on, one case study, one of my deals. So it's all real stuff, real deals from beginning to end. Why did I pick that market? How did I do my research? The data, where did I find the data? I teach them. Why did I pick that property? Why did I choose that specific financing strategy to buy this asset? What happened afterwards? If I refinance, what kind of return on investment I got? One deal. And then if you come to the live event as well, I have guest speakers, another mortgage broker that again brings additional, case studies that you can work on. So you can see how these various financing strategies, because they have to fit the specific circumstances of your deal. That's what I do. And I have an online course that does the same thing. The live event is always very cool because as you mentioned earlier, first step is to take people to conduct a physical experience, a physical inspection, of an apartment building accompanied by a professional building inspector. And then we get into case studies as well, the offer process. I show you samples or examples of actual offer to purchase, why I structured them that way and all of that, specific clauses and all that jazz, all the way to putting your financing together. That's what I do, online or live event. So
from that website, is that the best place to get a hold of you?
multifamilyinvestingcanada.com.
Perfect. And you have an email address there and all that kind of stuff?
Yeah. Okay. Or people can reach me at Turgeon@matterhorninvesting.com, Turgeon @matterhorninvesting.com.
Perfect. Well, we got one more segment to go, guys, and I can't help with a big smile on my face. Not because it's just so beautiful outside, but it's just I'm enjoying catching up with a really good friend here as well.
Likewise.
So we'll be right back. Well, welcome back, everybody. I sure hope I got all the cameras turned on. It's like when you're just getting so much gold. I'm just getting so excited that I have to forget I'm the cameraman too here at the same time. Just thoroughly enjoying our conversation here, and and here's the thing that's coming with all these interviews is the onion is so many layers that it's almost turning into multiple conversations. I welcome you anytime you're on my way into the coast. I will cook eggs. I'll go down to the store and buy them. I won't pick them from the backyard, but you're more than welcome to come to the studio. And I'd love to have another conversation as well.
Love to do that.
Okay, so 2 things I want to talk about at the very, very end here. I'd be remiss, which is it's great because we're going to talk on both ends of the spectrum. I'd be remiss if I didn't ask you about the whole realm of risk and risk mitigation, because that's what you're known for, and you've lived in that world for so much. But risk to a point, then there also has to be that you have to actually shoot the puck and do something. So I think it's a perfect final conversation. So what would be your best example or best tips and hacks and strategies you would offer people in order to do your diligence and mitigate the risk on your investments for investors?
Yeah. And it's cool because in order to answer that question, Russell, I can go back to my background as the manager at CMHC of default management in real estate. So as I said, my experience is very cool because it's from the offensive point of view when you buy or refinance an apartment building, also when the default. So I know what bad deals look like. And I think the biggest mistake I saw, so first of all, good news about apartment buildings, they rarely default. To this day, we're having a severe recession again in Alberta. I mean, we're out of it officially, but the negative impacts are still being felt and suffered. Oh, big time. This is a long freaking hangover.
And we partied way too hard for too long.
No, definitely. But in my days as the manager of defaults at CMHC, is usually the property risk factor is one where people fail oftentimes. i.e. they underestimate the kind of repairs and upgrades that are required in the property. Like a roof, depending on the size of the building, let's say a 20-suite building is going to cost you easily 60 grand.
Yep.
So, you know, when you conduct your due diligence, you have to assess the physical condition of the property very thoroughly and to assess these repairs and upgrades that may be required. Because if you have not planned for this and it happens during, you know, the ownership of the property, you may not have enough cash flow to pay for that, right? And usually, so what you do in that regard, the way to mitigate that risk is a thorough assessment of the property, done first of all by yourself. Usually, what I teach in my course is go and do a walkthrough yourself.
Yep.
If the property is too scary, listen to your gut. That's God speaking. You know, call it whatever, your intuition. Okay, listen to that. You do your walkthrough. You don't like it, then walk away. It's that simple. Then if you think it's good enough, you haven't been scared by the property, then get a professional building inspector or an engineer to go through it and do an inspection. And if they identify significant repairs like a roof, what I would do for a roof, either I try to negotiate the price down with the vendor, or I would raise money accordingly to be able to replace the roof.
Yeah.
The other thing that's what you do. So you go through all various building systems, mechanical, building envelope, plumbing, and all of that to ensure that they're sound. And if not, have money aside or reduce the purchase price to address those. But oftentimes people, if they don't do that, then they get into a situation where they need to make a cash injection to the property and they don't have the money. So then that's a problem.
You almost have to assume that, and quite frankly, if you're in it for the long game, this is one of the things, how do I best say this? When I first got started, we all heard invest for the long term. I'm in for the long term, but what does that exactly mean? It almost means that if you're going to own a property for 10, 15, 20 years, almost everything in it will have to be replaced. And you have to almost account for that along the way, right?
Absolutely. You know, you've got multifamily apartment buildings at bare minimum, even 10 years now, I'm getting into that round where that 10-year period has come around. And that's the worst of it. So the concept here is remaining economic life, Russell. You may recall me saying this. It's a remaining economic life, REL, of various building components. And you're right. Everything has a limited remaining economic life. So sooner or later, you're going to have to replace the roof. Good news about the roof, you got usually 25 years easily. A boiler, something like that, 15, 20 years, right? So different things, and you got to keep in mind, depending on the age of the property, the turnover of replacement for these various building components may be greater if it's an older property, right? Yeah. So your operating expenses are going to be greater if you buy an older property.
So all that will determine a purchase price, right?
Yeah, purchase price.
And then it also will determine how much cash is required.
And how much contingency fund to have in place.
Contingency fund you'll have to have. And it all builds in. You're doing all of this before you probably even write an offer.
Absolutely.
Right? That's part of your
That's the
process.
assessment I make very quickly. Yeah. Very quickly.
And I wish, and this is one of my hopes, and I wish I would have done this in my single family, taking that much time and attention to really take a look at all the mechanics. And it's smaller on a single family, you're just looking at a furnace and a hot water tank and things like that. But build all that in from the day one.
I do.
Right?
Like literally, Russell, some properties, like let's say if the vendor, let me pick a roof, which is one of the largest capital expenditure that you can have. If I will address all of that. Usually I try to stabilize the properties as fast as I can. For example, the building that I've got, like I said, I've got on the lender's desk and we're going to get funding in the next week or so. It needed a new roof. It needed, what else did it need? It needed new railings that were not up to code anymore, right? Now the height of the railings is about 4 inches higher. So as soon as we took possession, I had lined up the roofing guy that we went in and replaced the roof and all that. But you see, I don't have that surprise. As difficult as it's been, as I said, now the real estate market in Alberta is very difficult. Those are issues I didn't have to deal with because I did my homework up front so thoroughly. That part did not surprise me. Imagine if I hadn't done that, all of a sudden you got an expense of 60 grand to replace the roof. Or you're not up to code, right? I mean, that's something else to check that the property's code compliant to bylaws and, safety, fire and safety and all of that. No, I mean, this is where it's cool to do what I do, like you do with your background, but I'm a lawyer, right? I used to be a lawyer. Don't hold it against me, please, guys. I quit the profession.
Love you
I'm not as anal as some lawyers.
Love you because I have to love you more.
But I am meticulous and that stuff pays well for me. that it pays off well. I don't have to deal with that, despite the fact that I have the market risk factors flaring up, let's say now in my circumstances now, at least I don't have to deal with the property risk factor, which I nipped in the bud before I even took possession of the building.
So I would imagine another bugaboo or hot button would be balconies. Probably anytime you see something, if you see it's an original balcony or something like that, you probably have to have that as a factor.
Oh, and that's very expensive.
Yeah.
That's super expensive.
Yeah, I've bought into individual units within apartment buildings and stuff, and balconies. Lo and behold, a balcony that falls off is a danger for tenants to live in there. Who would have thunk? Huh?
No, I'm super thorough about these things, Russell. I'm super thorough. That I'm anally retentive about. Oops, maybe I shouldn't have said that in the video, but that's I just pay a lot of attention to that, because I know from my days as a default manager at CMHC, that's a lot of challenges occur there. Or over leveraging, the other big risk that people do, over leveraging.
Yeah, paying too much and also financing too much. And that's a conversation I'm having with a lot of, especially new investors who are in that, I want to grow and I want to scale and things like that. Sometimes more is not the answer.
Nope.
And I had a conversation with a fellow who had a free and clear house. And I said, that's fantastic. He goes, no, I'm going to go to the bank and I'm going to pull out the equity from it. And I go, actually, my goal is to be free and clear of my properties. Right? Having a portfolio of 15 free and clear houses is completely different than having a 90% loan to value on 100 houses. Right? It's a completely different, you look at like differently in that case. And the goal is that we eventually own them without mortgages. Right?
But which is why this question of being full-time at it, even that aspect I question again, right? Because of the current market circumstances that we're in. I'm certainly I'm doing different things now to have a secondary income, right? Because you got to be able to go with the waves, the cycles of the market, the real estate market, when the times are not so good. You're not making a lot of money, but long term, owning the properties free and clear, of course, is the ultimate goal. And that's when the cash flow comes in straight, right? To you don't have to re-inject into the property as much.
And then that's the lifestyle. So you really, if you're really guys, maybe a point is that always be looking at it from a standpoint about your being the ability, how a bank would see you. A bank wants you to have free and clear properties. A bank wants you to have all this surplus income. A bank wants you not to have to borrow the money, and that's when they'll lend you the money. Right? So just always look at it from that standpoint. So the final line of questioning, which is a perfect transition from risk. So you're fantastic from mitigating risk and analyzing risk. But there's a fine line between getting stuck in only seeing risk and then flipping it over to the other side, because you actually have to shoot the puck and take action. So what is the avenue of when do you stop trying to look at what can go wrong, and then when do you start focusing on the what can go right, and what do we do?
I can only answer your question generically, because everybody risk profile will be different, right?
Some people like to knit and some people jump out of airplanes.
Exactly. So the idea, and this is something, all I can tell, is what I'm about to tell you, is you need to figure this out for yourself. What's your appetite for risk? The good news about every risk factor that I mentioned, right? Property, market, valuation, or the value of the price, and the board can be mitigated according to your risk profile. So that's what you have to figure out for yourself first, and then with your investors. Because look, if you want to mitigate the valuation risk or the cash flow risk, well, the less you bore, the more the bigger your cash flow, right? So if you're worried about it, and if you think about it, any real estate investment, Russell, our biggest risk is that of not enough cash flow, not enough to pay for our expenses and all that, our mortgage and all of that. So if you want to mitigate that risk and sleep at night, put more money down. However, know that it's, I keep it very simple, even in terms of calculating returns on investment, cash on cash return, how much money goes in, how much money comes out. But if you put more money down to mitigate that cash flow risk, then your return on investment goes down as well. So you need to find the balance that's appropriate for you and your investors. Those are the kind of conversations, we're talking about a questionnaire to select, joint venture partners and all that. Those are the kind of conversations you need to have with them. An investment horizon. But the good news, my key message is every risk can be mitigated. If one is too much for you, well, then mitigate it. Right.
And maybe it could be as follows: is work with somebody who is an expert at mitigating risk, if you're not good at it, or
Yeah.
you don't even want to think about the risk, and I just don't want to be bothered. I'm a big thinker, visionary, and I'm flying.
Yeah.
I'm the entrepreneur. Then work with somebody who can do all that, right?
Oh, but somebody's got to do it.
Somebody's got to do it.
Somebody's got to do it.
Doesn't mean it can't be ignored. Yes.
No, it cannot be ignored, and the lender's going to ask you. They're going to ask you these questions,
Yes.
right? And that's the good news for me. Is like I said, I know my systems work because I have repeat investors time and time again. Like I said, I'll get the money even before they sign an agreement because they know what the agreement is going to look like, and they know I've got systems in place. Same thing with the lenders. Yeah. I get away with things with lenders because I have these systems in place. But I know where you're coming from. People fear risk. Gosh, we've had, you and I and everybody who's invested in real estate, ups and downs. But would I go back to my cubicle at CMHC despite the challenge I'm even experiencing right now? No, I wouldn't. No, I wouldn't. I have we do this because we want a greater freedom. Yep. And I do have it. And the greatest freedom of all, financially, sometimes there's downs, but I have freedom of thought. Russell, how priceless is this? I mean, when you work for an employer, and I'm not disparaging people who have JOBs, jobs at all, but now that I don't have a JOB, I'm self-employed, I can think. Because when you have a job, it's your employer who owns most of your time and your thought process, which is directed at doing the work that you do. And being able to think is a lost art in today's world. And
people don't take the time.
No,
right?
And I enjoy that. I can think bigger picture. I can go in the middle of the day, go to a yoga class or take vacation. I have that freedom, but it comes at a price. But those are the rewards from taking risks.
Yeah. Yeah. Sometimes it's the silence between the notes that create the music.
Absolutely.
Right? And it's just that being at peace of mind. It's that contentment. It's just that creating that lifestyle.
Yeah. So, and greater awareness.
Absolutely. So what's next for you? What's the vision look like for Pierre-Paul Turgeon? You've accomplished so much, and it's funny every time. Oh, and by the way, I was a lawyer, and oh, by the way, I created the Palestine Mortgage and Housing Corporation. Oh, by the way, it's just like it's one of these just side things. You've accomplished so much in your life.
Yeah.
What's next on the horizon for you?
To be honest with you, Russell, I have been doing this like you, well, not less longer than you, but, now I've got this online course and those live events that's taken me years to develop with the assistance of a third-party consultant. Now I really look forward to serving these people, making this more of a business line, being on the internet more and all that. I mean, I do speak across the country and all that. I look forward to that because I feel I've barely scratched the surface. I'm very lucky. There's not a lot of people with my kind of expertise across Canada, and especially people willing to share it, right, in a formal manner out to the public. So I look forward to finally doing that because I've got a product which, as I said, it's taken me years to do that. So that's one thing. Yes, a book. If I can stop long enough, and I love writing. I'm a good writer. That's something I definitely want to do. But also taking it to the next level. I've got to tell you, I nearly bought a brand new property just a year and a half ago, I guess 2 years ago now, with two guys. So actually the same guys. There were two guys that owned the company, and they were about to invest about $8 million with me. So that was brand new product. So getting my game to that level now that I've got all these systems in place. That's buying larger properties, absolutely. Right. Because there's benefits attached to that, newer properties in particular, right? Your operating expenses are significantly lower. But I'm learning lessons now as well in this current, real estate environment that's challenging. So I want to implement some of these lessons as well. Yeah. But the biggest thing is to, have this course and teaching and how to invest in apartment buildings and all that as a formal business. Be out there marketing is something that I'm learning, be on the internet and all of that. And so that's what I look forward to.
Just providing and giving back and be of more service.
Yeah, because
you're tremendous service already, which you have contributed.
Yeah, well, I barely scratched that surface. So to me, it's important to go all the way. How you do anything is how you do everything is what I teach my children. And I just feel in that world, I've been dabbing here and there on the side, and now I want to go to my maximum potential to be able to serve and share the knowledge I have because, there's a need for it and there's a demand for it. And
now,
I enjoy
before I ask you the final, which I kind of ask everybody at the very end is kind of a little bit of a final inspirational message that you want to leave people with. But before I do ask that, I wanted to just first acknowledge and just pay some gratitude for who you are and
Thank you.
Your value that you bring and your willingness to help and contribute and just the willingness to open people in with open arms. And you just have family is important to you, and you treat everybody you come in contact with like family until they don't deserve to be treated that way. But I'm just honored to have known you all these years, and I think that you just come from a place where you just have an amazing heart and your willingness to serve.
Well, likewise, let's backtrack a little bit on that. So my mission, by the way, and I have a mission statement, is to democratize the access to multifamily investing in Canada. That's my mission. My purpose, as a matter of fact, Russell, is to instruct, so that is give knowledge so that people can act upon it, inspire as well, because without inspiration, you don't take action, right? And that's important. And my goal, and you're right, success has to come from that heart place. Yes. Right? I want people to succeed. You know that. I'm still in touch with successful students of mine that bought their apartment buildings. Once in a while, they need a little bit of input and a little advice. But my hope, right? Because we do this to create wealth for ourselves. And my hope is by helping people to create wealth through investing in apartment buildings in Canada, that they will do good in the world with the wealth that they create. And I mean this. This is what drives me when I do this stuff, Russell. It's important because we said we are blessed despite challenges. Everybody always has challenges. Depends how you frame them. But that's important to me. And because I do get the struggle like you, like I said, I come from a poor family, number 9 family of 12 in Quebec. And I want this journey of investing in apartment buildings for people to be a lot easier than it's been for me. Yep. And I am privileged and blessed to have this insider's knowledge, right? That's cool. I feel I can't sit on this.
Yes.
I cannot just sit on it.
Yep.
And so... And I will always err on the side of generosity. Yeah. That's how I am.
That's why I think we're quite aligned. For myself is in the simplest version is I will always leave people feel inspired, encouraged, and I will always come from a place of love. Yeah, that's what you can count on me for. And I think that's very aligned there. All right, so the final thing I'd just like you to leave with people, and you can pick whichever camera you like. Maybe this one over here, that one right there, and get really heartfelt and soulfelt. Yeah. So if somebody's maybe just looking for a little bit of an inspirational message to they're maybe feeling a little bit stuck, and they just are just need to take another step forward, what would be a message that you would leave with that person?
So I think about that a lot daily. So you saw my gratitude rock earlier. And literally, I when I get dressed, I have to have that rock with me, even if I work in the garden on the acreage. So being in a state of gratitude and compassion, every day I work on my mindset, Russell. That's super important. If somebody is stuck, you said it already in between. You just got to take action, do something. There's genius in taking action. Remember our good friend, Philip McKernan would always say that. And it is so true. To be honest with you, I've got huge challenges at this very moment, day in, day out. And some days it's harder, but you go for a walk. But at the end of the day, move forward, take action, because then, and also move, but also take time off, like meditating and all that. I go to yoga, which is a form of meditation. We're 70 minutes, hot yoga, by the way. But take action. When the world looks dark around you, don't sit around. That's the worst thing you can do is to take action. And again, when you live in a state of gratitude, like, look, you just said it, like we're just around beautiful fields, Rockies over there, the cows, the horses, my chickens, that you and I here, hugging your family members. I live like that, right? It helps you through these times. And so I think, but take action. When the going gets tough, don't keep moving and keep being alert. The one thing, Russell, that I'm so grateful, and I'm going maybe too long at this, but this one question, but
you can never go
that touches me really. This is the one thing that I'm grateful. I did allude to that being self-employed, it comes with a high price, right? When there's a problem, by the way, this is something I teach. When you come to my workshop, the live one, and I learned this from my big sister. When there's a problem, Russell, there's always a solution. And if you cannot find the solution, that means you're part of the problem.
Right.
This is very powerful. The solution is always there, right? And if you can't find it, it's your problem. And there's means to find it. But the greatest thing I'm grateful for, being self-employed and through, the benefits of real estate investing is that freedom of thought, which in turn, being more aware of my thoughts and choosing thoughts that serve my goals and my purpose, but it's to have the ability to have developed a greater awareness. Like, I don't know, until I got to the point where I'm at with some financial freedom, despite the challenges that might entail, I have more awareness of what's around me. Mm-hmm. And when you work day in, day out, you don't have, at least I found it was hard to have that awareness. Yeah. So taking time out, I'm an outdoors guy, as you know, and stuff like that. But when it gets tough, keep moving.
Yep. When you don't know what to do something.
Anything.
Right? Anything. A bad plan is better than no plan.
And more specifically, Russell, this is something I researched. Like, you go on YouTube, guys, there's lots of resources out there. Tony Robbins, like he says, if you've got dark thoughts, just physically move, do any motion, get up, and you'll see. But we have a choice of our thoughts, and we can do so much. And I don't mean to BS people. This is true. I believe that. And you have to believe that to get to greater things. To buy apartment buildings, you have to believe you can do it. And you can do it. You don't have to be a former CMHC underwriter to do this.
Absolutely.
But take action.
Couldn't have said it better myself. So thank you very much.
Thank you, Russell.
That was a gift, and it truly was like Christmas. We opened it off we unpacked a lot of presents, a lot of unpacking today, a lot of presents that were unwrapped. So, So guys, stay tuned. There's more of these coming. I'm committed to bring these stories, introduce you to people that you might not know. And Pierre-Paul is honestly, Pierre-Paul, I think you're just getting started. You're in like the second inning of a 9-inning game.
I think so,
and
Russell.
You're just getting started. I can't wait to see what's next.
I think so, Russell. Thank you.
I can't
Appreciate
wait. So guys, stick it out. There's more coming, and we'll talk to you very soon.
I sure hope you enjoyed this in-depth training video, and I applaud you for sticking around right to the very end. I believe in people that show up, put in the work, put in the time, and effort should be rewarded. If you're interested in taking the next step, if you're interested in going deeper and mastering what you just learned about in this training video, I encourage you to check out the Raising Capital Academy. So if you have found that you've received some value from the YouTube channel, or maybe you've listened to a podcast, you're only scratching the surface. That truly is just 1/10 of 1% of all the content and materials that have been created that are waiting for you on the other side. So I encourage you to check out the Raising Capital Academy. There's more than 100+ hours of video content, audio content, exclusive training material for those that are interested in taking the next step, those that are interested in going towards mastery, those that are interested in moving forward with velocity. So I would encourage you, wherever you're watching this video, around this video will be a link where you can check out all the details of the Raising Capital Academy. After you've checked out all the details on that page and you're interested in moving forward with velocity, click on the link that will take you towards the application. This is by application only. This is a community program and is for serious action takers only. So if you want to step up your game, if you have goals and dreams and aspirations for more, if you'd like to make a difference in the financial futures of the most important people in your life, I highly encourage you to check out the Raising Capital Academy. Click on that link and you'll be taken to the next step in the process to see if you qualify to take the next step forward for you. Hope to see you on the other side. Bye for now. Well, I sure hope you enjoyed that video. 2 simple things to do from here. If you're interested in continuing your journey, interested in continuing to become a successful real estate investor, just below where you're watching this, there will be an opportunity for you to subscribe. And if you're interested in continuing your journey, there is a hand-selected video over here for you. It's been hand-selected for you to keep your journey going forward. Thank you very much.